When we talk about exponentiality in finance, as a futurist, you're always looking for analogies. Where can we find some reference point in terms of patterns that might develop? Now, when we talk about banking, one of the things that's going to impact banking the most is behavioral shift. Historically, we can see interesting behavioral shifts as a result of technology disruption. For example, the Luddites in 1812, how they pushed back against the steam machine. And 200 years later, we see taxi drivers responding in an identical manner to Uber. So there are good patterns for us or analogies when we look at these types of disruptions. But in banking, there's been a fair bit of resistance to the digital change, this digitization. Banks have persisted that they'll be able to make this transition despite the fact they're sort of still hanging on to their old revenue structures and product structures and so forth. We haven't yet seen the level of disruption we've seen in other industries, but it is coming. So I was trying to find an analogy for how this technology is impacting banking for the new book I'm working on, Bank 4.0, which will come out over Christmas, hopefully, if I can get time to finish writing it. And I started looking at the technology trends in banking. So when we look at the first major technology that impacted banking, it was the mainframe. Now, some of you may or may not know this, but the first bank mainframe was built by MIT for Bank of America right here in New York and San Francisco. And this first mainframe, called IRMA, Electronic Recording Machine for Accounting, I guess this is where all the acronyms come from in banking, right? It started with computers. Back in those days, if you were an account holder at Bank of America, you didn't have an account number. You had an index card somewhere at a Bank of America branch. But when the mainframe came along, computers at that stage couldn't sort alphabetically. They had to sort by numbers. So everybody was given a unique number. And that was where account numbers came from. So you can blame MIT and Bank of America for bank account numbers. So this was the first major technology disruption in banking. The second tier was self-service banking. And back when self-service came out, we all thought this was going to disrupt banking as well. But we are starting to see some significant change in the way banking is distributed today. And that's coming through this experience layer that's emerging. Now, we start with the mobile, we start with smartphone, but this is just one of the technologies that's going to change the way we access banking in the future. And the big significant shift here is we no longer have to go to the bank to get access to banking. It's becoming embedded in our lives. So when banking becomes part of our day-to-day experience, this diffuses the brand and the products and these sort of elements that have been a part of banking historically and really changes the mix in terms of who are the influencers and makers in this new structure. So I was trying to find a way to think about how would we design banking for the future if we started from scratch today. And there is actually a good design philosophy principle behind this, and that is, there's two major engineering streams in terms of design. One is design by analogy or iteration, and the other is first principles design. Now, if you're a student at Elon Musk or Steve Jobs, Johnny Ive, you'll know that they employed this first principles thinking with their product design. But let's sort of take a deeper look at this, and we'll start with this, the V2 rocket. So at the end of the Second World War, it was clear that Germany was going to lose the war, but there were 1,500 scientists who worked on the V2 program that the British, the Americans, and the Russians were all rushing to try and get at. The US had an operation, a secret operation called Operation Paperclip, where they had a list of all these scientists' names that they tried to capture. And just right near the end of the Second World War, one of the major architects of the V2 rocket program, this man, Wernher von Braun, surrendered himself to US forces in Austria. Now, von Braun went on to become the architect of the Apollo program. Now, at the time, the Apollo program, each launch was about $1.2 billion in today's terms. And this cost about $6,000 to get a pound of stuff into orbit based on the Apollo days. And in the last 50 or 60 years, we've iterated on this design, but we've only got the cost to orbit down to about $3,000. This is a pretty significant shift. But it's not enough. If we're going to be an interplanetary species, we have to change the dynamics of this cost. And so this is where Tesla and SpaceX and Elon Musk comes in with first principles design thinking. So Musk comes along, and in 14 years, he's been able to reduce the cost to orbit potentially by 95% from the space shuttle days through reusability, 3D printing, and thinking about different manufacturing techniques and different ways to construct this. Now, this is pretty significant. I don't know if you've seen them landing on the drones. I'm sure you have, because it's pretty spectacular. But you see those YouTube videos with people flipping bottles, trying to land them on their end. I mean, these guys do that from orbit, so it's a pretty neat trick. But this is only possible with starting from scratch, rethinking the design of rockets and rethinking the manufacturing process, rethinking the materials. Really just saying, if we were going to build a rocket today, how would we do it today with all the technology we have? Would we do it the same way Werner von Braun did it with the V2 rocket? And the answer is no. And this is how you produce exponential change. Now, another great example of a product where this first principles design thinking comes in is the iPhone. Steve Jobs didn't take the Motorola StarTAC, the flip phone, the Nokia banana phone, or the BlackBerry and iterate on that design. He said, if we're going to incorporate an MP3 music player, a browser, apps, and a phone into this new device, how would it work? And the story goes that Johnny Ive and he would carry around a block of wood and they would sketch up on Post-it notes how this would work. And this is apparently where the pinch and the poke interaction and these things came from as I was thinking about this new paradigm. But in banking, we don't see any evidence of first principles thinking from incumbents within the industry. We only see iterative design. And this is a big problem given the exponential nature of banking and finance at the moment. So when the iPhone came along, how did the banking industry respond? Well, the first reaction was, much ado about nothing. It's not really going to change banking. Might have an impact on a few of the fanboys, said Bloomberg Finance back in 2007, but it's not going to change the industry. But it has changed the industry. And one of the major areas where smartphone is impacting is the nature of the bank account and the nature of payments itself. But instead of using this to think about exponential payments and exponential banking in a new way, the banking sector just took a piece of plastic and shoved it inside the phone. This is iterative design, right? So we took, essentially what we've been doing, this whole process is taking what we did in the bank branch, iterating on it to put it in the phone. Think about internet banking. When internet banking came along, what banks did is say, great, how can we use this? Let's put a bank statement online and call it internet banking, right? And so we did that. That was the first generation, first iteration. And then mobile came along, and we're like, right, how do we iterate on that? Let's put internet banking on a small screen. That'll work. So this is iterative thinking. We don't need a plastic card. We don't need a 16-digit card number. We don't need any of that to affect a payment on a phone. So why have this analogy in the implementation of this? It's because from the incumbent perspective, we keep iterating on the branch and the product model we had in the branch to sort of try and digitize the branch. But we do see evidence of first principles thinking. The most successful savings product of all time is actually a mobile money market fund out of China today, Yuebao on top of Ant Financial or Alipay's platform. They've taken in $93 billion in deposits in just the first 8 months of operation. It's been so successful that the Chinese government has recently put controls on this in terms of how much Yuebao is allowed to take in, because this has disrupted significantly the savings market. If you're a bank in China today, your deposits are at 40% greater risk because of Yuebao, not because of another bank competing for your deposits, because of a technology platform competing for payments. Now in China today, 90% of all payments go through two technology networks, Alipay and Tencent WeChat. Now this is a big shock to UnionPay, MasterCard, Visa, and the banks who thought they had dominance in this space. But here's the more shocking statistic. This year, we expect that China will do close to $9 trillion in mobile payments. The US, about 100 million. Last year, during Singles Day, which is sort of the Cyber Monday of China, Ant Financial, Alipay on top of the Alibaba platform, and Taobao processed $17 billion of mobile payments in one single day. 96,000 transactions per second at peak load. Visa's network does 9,000 transactions at peak load. on a global basis. But here's a more interesting stat. One day, 17 billion in payments. Last year, the US did 8.7 billion in payments for the entire year. Venmo, PayPal, Apple Pay, Samsung Pay, 9 billion. China did that 2 times that in one day. So when you're looking for evidence of where we're going to go in terms of the next 30, 40 years in banking and finance, the US is not the model to look at because we're iterating. We're not exponentially growing payments and banking. Part of the problem is we still think in banks, we still think the branch has some value. And we're starting to look at banks in terms of branch of the future models and things like this that could iterate further technology into the traditional banking landscape. But here's the problem. It's not a design issue. You know, bankers think like this. They say, people camp outside of Apple stores for their new iPhone. So maybe if we make our branches look like an Apple store, they'll come back to the branch. It'll be great, you know. I've never seen people camping outside for their new checkbook or debit card, but outside their bank branch. But here's the problem. The reason customers aren't coming to the bank branch today is not a design issue. It's not because they don't have enough screens or enough coffee machines or nice couches or these sorts of things. The reason simply is, with this device, I just don't need to go to the bank anymore. It's a behavioral change. It's a behavioral shift. The only way you're going to get people back in the branch is not redesigning the branch, it's taking their iPhone off them. And that's not going to happen patently. So this is a problem if you are an incumbent looking for revenue and seeing people come out of the branch and you don't have a solution to engaging customers on an experiential basis on these new channels. And it's certainly a problem if you think that a mobile phone is a channel to push a new credit card on, because that's iterative thinking. And this is the problem we have. Banks think of everything in terms of this branch model that they've built over the last 700, 800 years, and they aren't ready to step outside of this model. But tech companies like Ant Financial and others, the fintechs who are now getting $40, $50 billion a year in investment, these guys think differently. And the first thing that these guys say is, let's get the friction out of the system. You know, let's not require a signature on a piece of paper in a physical building to issue a bank account. Let's think fundamentally about lowering the friction. And yet, you see the banks, they say, hey, mobile's our biggest branch. And that shows the iterative thinking that we see in the incumbent sector. So I guess the real question is, where we're going with banking over the next 30 years, do we really need banks to provide these experiences? Well, one great illustration of how banking will become embedded in the world around us is the driver sign-up process for Uber. Here in New York City, about 30% of the 40,000 drivers that have joined Uber never had a bank account. And so the first thing they had to do before they could sign up to drive for Uber was to get a bank account. But as you guys know, this is not easy to do these days with KYC and IDV and Patriot Act and CIP and all these things. It's hard to get a bank account today, which is why 25% of US households are unbanked today. It's not anything to do with branches, it's the identity hurdle that we put in front of customers for that. So what Uber did is they said, well, you know, the identity requirements that we have for a driver to sign up for Uber are roughly the same as the identity requirements to get a prepaid card. So why don't we just issue a prepaid card to our drivers so we can pay them, because they couldn't get paid in cash. And within just 3 months, Uber became the 3rd largest acquirer of small business bank accounts in the United States. This is pretty impressive. But you know, Uber didn't want to be a bank. They didn't want to be a leasing company. But what they did is they wanted to build their platform, their business, and they needed these capabilities built into the platform to grow their business exponentially. So they started issuing debit cards. They started giving drivers leases on new cars. Should banks be nervous of Uber that they're becoming a bank? Uber doesn't want to become a bank, but they need banking embedded in the platform. And we look at Amazon, and we look at Facebook, and we look at Apple, and we look at Ant Financial, and we look at Tencent, we see evidence of platforms building banking experientially into their platforms to get stuff done. They don't want to be banks, but they need banking wired into their systems. But they're not wiring in bank products. This is WeChat, WePay. Now it's in 77 countries already around the world, and this is an example actually from Thailand. But you see, these guys didn't build a debit card. They didn't build a 16-digit account number. They didn't build a bank account number. They didn't issue a bank account like a traditional bank does. They just provided a payment experience built into their app platform. And this is a good illustration of where we see banking going. Payment experiences instead of a payment card. And when we look at that product shift to experiences, we see evidence of the fact that a payment experience has to be different than a payment product. It doesn't need a card, it doesn't need a bank account, but it does need payment capability, and it does need a value store. In fact, ultimately, this shift towards experiences, particularly in retail banking, is going to ultimately distill us down to 3 banking products only. A value store where you can safely put your money, the ability to pay or move money, and the ability to access credit when and where you need it. And these are going to be surfaced experientially on the basis of utility. So at Moven, for example, we launched savings last year. We call it our stash. And we built a behavioral-based savings product. So instead of opening a savings account or pushing a higher interest rate to promote savings, we simply said to customers on their smartphone or on their watch, hey, you're $200 below your typical spend. Why don't you guys lock that away? Why don't you save it today? And just that behavioral message created a 40% conversion for people putting a deposit into a savings bucket. But we didn't offer any interest rate at all, no APR. So name a traditional bank that's been able to create a savings product with 0% APR that's got 40% conversion off a sales campaign. You won't find one. But that's because we're not selling a savings product. We're enabling savings behavior. And that's the way we're shifting. We're shifting towards experiential behavior in finance. Now, I want to illustrate this product design problem, referring to our good friend who sometimes plays Donald Trump, Alec Baldwin, and his ad that he did recently for Amazon Echo or Amazon Alexa. Now, I want you to notice, particularly in this advertisement, how Baldwin conducts a transaction, and think about the payment rails that would be needed for that transaction.
Yeah.
You're okay. He's okay. He made it.
Jason, what do you mean?
We were very bad boys.
Alexa, what's in the news?
Here's the news.
Alec Baldwin and Jason Schwartzman were seen mooning paparazzi. Baldwin grew a shoe at photographers before making a run for it.
My poor cashmere socks. Alexa, reorder another pair of Brescianis.
Reordering Bresciani socks.
Okay, listen. Can you send some lawyers or something?
Alec.
Good ad, right? Shows the capabilities of Alexa. But of course, these smart assistants are going to be embedded in our world pretty significantly over the next few years, whether it's through HomePod, Alexa, or other technologies like them. Our personalized smart assistant is really going to take a large chunk of commerce for us. So instead, in a few years, instead of us getting onto Yelp and looking for a restaurant review and then going and booking or calling the restaurant to make a reservation, we'll just say, hey, Siri, book me a restaurant in Chinatown for 5 people. Make sure it's 4-star rated or better. Or, hey, book me a flight, Alexa, to Washington on Saturday. Use the corporate account. And that's the way our agent or our smart assistant will handle those commercial transactions for us. Now, you notice what Baldwin bought? What did he buy? Cashmere socks, $200 cashmere socks. Something tells me Amazon probably paid for them. But in that process, he simply said, hey, Alexa, reorder me a pair of Bresciani socks. He set it into his smart assistant in this form of Alexa. Let me ask you, do you think the airline miles program that he has on his credit card had any impact in terms of the decision he made in terms of what bank account he used to pay for his socks? Do you think it's realistic to think that he would say, Alexa, reorder me a pair of Bresciani socks. But hang on a second, Citibank, MasterCard have this airline miles deal later this month, so use this number, 5764. Is that the way that transaction's going to take place? Obviously not. So here's a design problem. If you're a bank and you have a credit card department and you're issuing plastic with a 16-digit card number, in this world you're of no value, you're dead. Those product features have zero value in this experiential world. So you have to change your paradigm in terms of design thinking. you have to start from scratch. So this is eroding banks in terms of their capability, and as China is probably about 10 years ahead of the US in terms of value store and payment mechanisms today on the mobile platform, we can already see that Chinese banks have significantly less value in that ecosystem than they did previously with physical artifacts across bank channels. Today, Ant Financial, Tencent, and these guys are eroding the real value of Chinese bank channels, distribution networks, and bank products and services because they don't fit cleanly into an experiential world. The only reason it hasn't happened here in the United States is we have this sticky legacy behavior around KYC and IDV that's regulated, and we have sticky behavior around things like writing checks, which is crazy. You know, the US writes 2/3 of the world's checks. It's like, when are we going to get over this? This is, you know, from the first century. The word check actually comes from the Arabic word sak, which was this bill of exchange they used on the Silk Road. So we're supporting Islamic terrorists somehow with writing checks, I don't know. But anyway, so the real question is, where do humans fit into this puzzle in the future? Do humans have any value in this experiential, exponential finance world? Because that's what bankers keep telling us, that people want advice from a human, and that's always going to be a part of the experience. But the problem with that is, as you get exponentiality, and as you build data and sensors that collect behavioral data, the value of a human based on advice diminishes also exponentially. Why? Well, think about the self-driving cars. You know, a LiDAR rig, cameras capturing all this information. 1,000 times more information than your human eye can process is captured by a typical LiDAR rig on a self-driving car. You know, when you're driving a car, you can see in front of you or where you look. Right? A self-driving car with a LiDAR rig has a 360-degree field of view up and down. So it captures a lot more data, a lot more information, and it can process that information 70% faster than your brain can. So statistically, no human, once this technology is mature, no human will be able to compete with a self-driving car in terms of decision-making because of the ability to capture data and synthesize it. And when you think about investing, when you think about the stock market, when you think about forecasting financial performance, the same exists. No human will be able to compete with an AI just purely on the basis of the ability to synthesize data. We use this term information asymmetry when we talk about why you should go see a private banker or a mortgage advisor or a wealth manager or a stockbroker, because they know something you don't know. That's why we need an expert to advise us, a lawyer, accountant. But once an AI has information asymmetry over a human, the human's value in that ecosystem is essentially gone. And this is where we're about to hit exponential finance, with the death of advice. So what sort of advice will you ask the financial system for in the future? Well, you'll ask Siri, hey Siri, can I afford to go out for dinner tonight? And Siri will say, no way, not after those drinks you had with Peter Diamandis last night. It's not going to work like that. But the sort of advice that we'll get on this platform in the future is not product advice. It's not the best mortgage for you. It's not the best asset class you should invest in. It's advice wrapped around your behavior. Because as smart assistants gets to know us, it'll know our financial behavior and how to coach us to be better savers and better financially healthy. This is a very different form of advice where, frankly, incumbent banks today have some of this data, but they have zero expertise in really institutionalizing this type of advice. Because the advice you get from a bank today is product advice. It's not financial wellness. But this is going to be the primary focus of merging the finance system, payments and money in the next few years around being financially healthy on these platforms. We already see AI is better at diagnosis of things like cancer with IBM Watson. We see AI emerging constructs that we can't understand as humans, such as the interlingua that Google's machine algorithm came up with for translation. And we see things like self-driving cars developing personality. I don't know if you know the story about AJ and Bobby. They're the two self-driving car test rigs that Audi built for experimenting with this technology. Now, they call them AJ and Bobby because test vehicle A and test vehicle B. But Bobby, same hardware, same firmware, everything, Bobby drives faster and more aggressively than AJ. When I interviewed the Audi team for my book Augmented last year, or the year before actually, I said to them, so why is that? Why does Bobby consistently get faster lap times than AJ? And the engineer said, well, yeah, we're not really sure, but we think it's because early in the cycle, in terms of machine learning, that Bobby got a driver that was more aggressive one day, and that sort of set him down this path. But there's personality between these two cars, so AI is going to surprise us. The advice will not all be the same. The advice will differ, and this will create enough personality in the exponential finance space that it will be interesting enough to keep working through AIs rather than humans. And even on the basis of identity today, we see that machines are fast outperforming humans. You know, you see the border patrols around the world instituting now facial recognition, biometric handprint and fingerprint recognition to get through passport control because those algorithms are way safer than a human. But 70% of the banks in the United States today still require a face-to-face identity verification in a branch to open a bank account. When you think about it, based on this technology, that's the single riskiest activity that banks do every day. Because we already have tech that's 20 or 30 times better than a human in identifying another human. So why would you ever require a signature on a piece of paper to open a bank account again? Now, when we look at how this is going to impact the financial services space, RegTech is one of those key areas. Look at anti-money laundering. Today, we spend $9 billion a year on anti-money laundering, and we stop about 2 to 3% of the money laundering on the globe. But in the future, we'll build AIs that will monitor network traffic, that will monitor capital flows, and be able to see where the cash is going. It won't be suspicious transaction reporting. It'll be AIs monitoring networks. And of course, blockchain is coming because we need dynamic structures that can create value stores and payment rails that emerge on the top of things like self-driving cars, for example. So if you imagine a self-driving car in the future that drives on the road, pays road tax, tolls, pays for electricity to recharge, can log onto the Uber network as an autonomous vehicle, and can take revenue from passengers who drive in its vehicle, it needs a bank account. It needs a value store. But you're going to get the car to come down the bank and sign a piece of paper, to sign a signature card? It's ludicrous. But with blockchain, we have the analogy to create these structures. The real reality is that if you're a bank today and you still have humans in the system, you cannot build a bank that is exponential. You cannot build a bank that can deliver revenue in real time across these new experiences. And that's why Elon Musk says there's no humans on the factory floor at Tesla, because they'd have to slow the factory down to human speed. It's the same for banking in an exponential world. So banks really have three choices. They can partner with the fintechs who deploy capital far more efficiently than they ever will. They can acquire those fintechs, or they can try and copy what these technology companies are doing. But imagine a bank trying to copy what Amazon and Apple are doing with a smart assistant in the home. It's ludicrous to think of that. But this is the difference. Banks no longer own the distribution channels where banking experience will be surfaced in the future, where that utility of payments, value store, and credit will be based on your behavior. They don't own that layer anymore, so they have to partner. And this is the only way to survive in an exponential world. By 2025, the largest bank in the world won't be a bank. Worth approximately $500 billion by the middle of next decade, on track to 3 billion customers on their platform, Ant Financial will be the largest financial institution in the world. And they won't be a bank, they're a technology company. If you're going to compete with these guys in the future, you can't be a bank either. Let's think about it. If you're going to start banking from scratch today, and you didn't know what banking looked like, would you really build these buildings that people had to come into and sign a piece of paper to get access to a physical banking product? The answer is no way. That's not exponential thinking, and that's not how the future of banking is going to work at all. And if you're arguing there's still value in this system, you're dead, you just don't know it yet. That's what I like to call Bank 4.0. Check out the podcast, Breaking Banks, as well. We feature a lot of the speakers from Exponential Finance on that, but thank you very much for your time today.